Hello, this is Dr. Frank Raganese with Pelican Wealth Advisors with your educational video series entitled Dynamic Portfolio Management. I believe that this is probably one of the most important videos that we've ever created because it differentiates what we do versus buy and hold strategy. Our dynamic strategy is the absolute opposite of buy and hold. It utilizes exchange traded funds, which are diversified, and implies that something's going up somewhere when the market's going down. And it's really great to take advantage of the kind of market activity and market volatility that you see in a bear market. So basically the difference is dynamic strategy is fast and quick like the Ferrari. Buy and hold is what I call the turtle. Now let's give an example as to why we feel that we're different in what we do. And this is an example of actual year-to-date performance through March 27th, 2020. This is during the height of the COVID-19 market meltdown. As you can see from the table, the Dow Jones is down 24%, the S&P 500 is down around 21%, and our average portfolios are down anywhere from 2 to 4%, or about an average of about 3.5%. And that has been accomplished by using the hedging strategies that I'm going to explain to you on the next slide. This is a table of what we call the ETF investing secrets that involves leveraged and inverse ETFs. For example, it gives you the opportunity to make money in both up and down markets. In the green zone of the table are the Dow Jones. If it goes up 10%, then the ETF with the symbol DIA will go up 10. And then there's a 2-to-1 leverage DDM, which goes up 20%, and UDOW goes up 3 times as fast as the Dow, 30%. If we're in a bear market, we can do the opposite, so that if we purchase DOG, and the Dow is down 10%, DOG goes up 10, DXD goes up 20, and SDOW goes up 30%. So these are called reverse indexed and leveraged ETFs. Now let's give an example of how you can actually profit from using these leveraged ETFs or reverse index ETFs in a bear market. And I'm going to review actual results from March 6th to March 23rd of 2020, 17 days during the peak of the COVID-19 market meltdown. I'm going to use an example of the Dow Jones ETF, which is the symbol is DIA. And we're also going to show how we utilize SDOW, which is the reverse index of ETF. It goes in the opposite direction to the Dow Jones 3 times faster. So if the Dow goes down 3%, it goes down 9. If it goes down 10, it goes down 30%. Now here's an actual chart of the Dow Jones during this COVID-19 or coronavirus crash. This blue line is the 200-day moving average that we normally use as a line in the sand. So typically when the price gets below this blue line, we start selling. We actually sold half at this point here, another half at this point. And then we did what we call hedging, where we bought a 7% position of the SDOW, which goes in the opposite direction. And then it went all the way down, and when it bottomed out, we made some profit here that I'll explain in a minute, and we sold the SDOW. Now, during the same period of time while the Dow Jones was dropping, you can see the chart on SDOW was actually going up. And this is a example of if you went and bought it at this point and sold it at that point, we didn't actually hold it that length of time. But if you were smart enough to figure out through all these gyrations to hold it during that entire period, you would have had a gain of 93% profit while the Dow was going down 31%. In our case, we went in and out several times and made profit during this period, but we didn't hold it for the whole length of time due to the volatility. So what does that mean? How is this being used? Well, here's an example of what we call hedging. And hedging means that we're trying to prevent the portfolio from going down when the market's going down by buying something that actually goes up. So here's a case. Assume a $100,000 account, and it has $70,000 invested in the Dow Jones average and $30,000 in cash. Now, if the Dow loses 31%, that's a loss of $21,700, which means now this account balance has dropped to $78,300. However, if you had purchased with this $30,000 in cash, if you had purchased a $30,000 position in SDOW during the same period that the Dow went down 31, this goes up 3 times as much, or 93%. And 93% of 30,000 is 27,900. And when you add that back in, you get a balance of 106,200. So the bottom line is, if you hedge, your account balance is 106,200. And if you don't hedge, the account balance is 78,300. Which would you want to have? Okay, now I want to show you a really interesting chart. This is UDOW. Now this is the opposite of SDOW. And what we're saying is that when the market starts to bottom out, if you can purchase even a small amount of the triplers, you can see what can happen. So here's the drop. While the Dow was dropping 33% during this period, UDOW actually dropped 69%. It's now hovering around here. We don't know if that's a low yet. But once we bottom out, you can see the potential for purchasing UDOW at the bottom and writing it all up. Now, this is a way to recover losses in clients' portfolios. If you have a portfolio with large losses, one of the things you could do to recover those losses more quickly is to use either a 2 times or a 3 times leveraged ETF. And here's an example. Let's say you had a $100,000 portfolio and you incurred a 30% loss or a $30,000 loss. So your balance is now down to $70,000. And you're not too happy with your advisor, or maybe you're managing the money yourself. Now, if the Dow recovers 30%, goes back up, the 70,000 times 1.3 is 91,000. Notice that even though you went down 30 and back up 30, you're still short $9,000 from where you started. Okay, that's what we call the magic of compound interest. You don't recover. You would need more than a 30% return to get back to 100%. Now, if we had purchased UDOW, which moves 3 times as fast, it would have gone up 90% during that same period. So if you purchased $70,000 of UDOW, which is an extreme case, but just as an example, it would go up by 90%. So 1.9 times 70 is 133,000. So which would you want? An account balance with 133,000 or an account with 91,000? So the point I'm trying to make here is this is a very powerful way to get really huge increases using leveraged ETFs. Now, generally speaking, we try to hold the amount of ETFs we're using with leverage to about 10%, and we usually don't keep these in invested position for more than maybe 3-4 days or maybe a week sometimes. Although during the crash in 08-09, you could have held some of these things for probably 3 or 4 months and made 200-300%. Okay, in the final slide here, what I want to talk about is the opportunity for huge profits going forward as a result of any market correction such as the COVID-19. And what we're saying is that we recommend using in our portfolios, we use the 1x, 2x, and 3x ETFs. Now, many of the sector ETFs that are triples, the 3x ETFs, are down even more than the major indices. So, for example, the travel sector, oil, aerospace, defense, healthcare, and banking. So there's a lot of huge potential opportunities for profits in some of these sectors. In fact, even purchasing even a 1 or 2% position in an oversold 2x or 3x ETF near a bear market bottom could potentially yield returns of 100 to 300% in future profits. Of course, we all know that there aren't any guarantees, but this is a strategy that we use very effectively. If you have any questions, if you have a portfolio, maybe you're managing your money yourself and you've taken a pretty good hit and you'd like to recover more quickly, or if you have any questions, feel free to give me a call at 239-287-3146. That's 239-287-3146. Or go to our website and watch some of these videos, which will be posted on our website, which is pelicanwealth.com. That's pelicanwealth.com. And finally, a disclaimer that there are no guarantees in the market, etc. So thanks for listening. I look forward to meeting you again on some of the other videos. Take care.